Today's Indianomics is on the transformation of Bank of Baroda over the past few years from a relatively ignored stock into a darling of even foreign funds. The current MD and CEO Sanjeev Chadha has an enviable record as a bank MD. When he joined Bank of Baroda as MD in the last quarter of FY20, Jan 2020 actually, the stock price was around 90 rupees. Today, as Chadha ends his term, the price is 190 rupees. In FY20, the bank had managed to eke out a profit of just 546 crore rupees. In Chadha's last year, FY23, the profit is 14,110 crore. The gross NPA then in FY20 was 9.4%, FY23 3.79%. Net NPA then was 3.13%, latest year 0.89%. Credit cost then 1.82%, now 0.4%. Sanjeev Chadha took over when the financial merger of Vijaya and Dena banks into BOB had just been completed, but he had to see through the integration of personnel and extract synergies. Chadha was also taking over from P.S. Jayakumar, who was the only instance of a private sector banker to become the MD of a PSU bank. In the 2 terms of Jayakumar and Chadha, Bank of Baroda has been noticed for accelerated digitization of services and for a lot else. To discuss how Bob has transformed in the past few years, I have with me the man himself, Sanjeev Chadha, Managing Director and CEO. Good morning, Mr. Chadha. Thank you very much for joining me. Well, actually, that is the first question. Very briefly, what are the 2 or 3 things, or maybe 5 things, that has changed in BOB over the last 5 years?
So I think for any transformation, first there needs to be an opportunity, and then there needs to be an agenda. So I think the opportunity was there because, as you mentioned, Mr. Jayakumar had really come in and brought a lot of change, and initiating change is always tough. The second was that there was a merger which was underway, and it is only times of transformation where then you can really give it momentum. Third, I believe, was COVID, which was a watershed, which had also allowed you to do things which otherwise would have been more difficult.
What did you observe over the 5 years as different?
So I think 4 or 5 things. One was, of course, the fact that coming from SBI, I think the central challenge was how do you make sure that you can get talent? Because if there was one thing which was different, it was SBI, of course, has a great model, homegrown talent, but what could you do in BOB? And I think it was a very pleasant surprise that that Mr. Jayakumar had initiated that change. We were getting people from outside, and as you progressed, you found that it was actually possible to get first-rate talent bank and to retain that. So I think that was the first element of transformation which was there. The second was technology, which was very important. Now we had made investments in technology, for instance, through a data lake, but ultimately it's important that technology gives you results, it touches the customer. And there with COVID, there was an opportunity to actually bring about a very wholesale transformation. That's where Bob World came in. Third was, I think, a performance culture, which is very important. And that's something that we were able to build. Now, if you talk to any of our people and ask them about how their branch, how their zone, how their region is doing, people have again the important performance metrics even at 3 o'clock in the night if you were to give them a call, right? Okay. And the fourth I think is important is again a governance agenda and a strong sense of ethics. We brought in Dr. Mukund Rajan to help us again construct a ethics agenda for the bank, because that is something that really is the bedrock of change that can be sustained. So I think these are 4 or 5 things which were there.
Let me take each of them in detail. One thing you didn't mention, and which other Bank of Baroda old timers told me, is that you've also introduced, or maybe with Jayakumar, I don't know, a collection mentality. I mean, until very recently, growing the balance sheet used to be the goal, but you gave a lot of stress to collection.
So I think it was really identifying that what were the missing pieces, right? And one of the missing pieces was, if you were to look at what is it that, where are we away from the best? One was in terms of growth rate. Public sector banks have been losing market share. The second was in terms of margins, right? They are lower, which are as compared to others. Third was in terms of, again, the asset quality.
Right.
Part of the asset quality is, of course, cyclical, and we have seen some of the upside from there. But fundamentally, if you want a sustainable transformation, it is the collection mechanism which needs to change. And what we found was, as compared to some of our competing banks in the private sector, the kind of resources that you deploy for collections, again, were suboptimal. And also, again, it was as a discipline not developed. So among the people that we brought in, we also brought in, again, a head of collections from a private sector bank who had been doing it for 20 years, built a large team. And particularly now, as we go into areas like unsecured personal loans, you go in for new to bank customers, I think it's very important that a collection machinery actually precedes, again, going aggressively into any business rather than succeeding that.
The other thing that clearly has succeeded, and you alluded to it a couple of times, the ability to integrate lateral recruits. I mean, now even the government is advertising for joint secretary level lateral entrance, but that's a new thing. That it has succeeded so much is a surprise.
So in some ways, you always try to do different things and see what works. So there are businesses which are not native to public sector banks, right? There are disciplines which, again, we have not really developed as well. And the question is, how do you actually acquire those businesses? How do you build those businesses? One way is to get a consultant and help you do it. But what we found was it was a far better idea and something that works far better if you bring in somebody, but somebody at the top, because it means that you bring in experience. You also bring in the ability to attract a team around that person who's building that business. And that's something that becomes a sustainable business
But
model.
won't you disturb the salary hierarchy?
So I think the fact is that the third pillar that I mentioned, performance culture, once you build that performance culture where everybody believes that, look, they do need to perform, there is no option, then people actually start coming to you themselves and saying, look, this is a gap that is there in my capability. Why can't we get somebody from outside to fill that capability gap?
Okay. Oh, that's good if lateral recruits have integrated so well. I'll come to these long-standing issues in a bit because the stock market will also want to hear from you the more immediate performance targets. One, your NIMS. As I said in the beginning, it's a superb improvement. I think it's the best in many years. But is 3.5 or 3.6 maintainable?
So I think there are some structural factors which are at play, which I believe should help us bring about improvement as we go along. There's no doubt that we again at a very fortuitous point in the cycle. But for us, for instance, again, you will find that it is the retail loan growth which has driven growth. So last year, overall growth was something like 17-18% in loans, but the retail growth was 27-28%. And that is something which is significantly margin accretive, in the current context, because corporate loans, again, margins have been under pressure for the last few years. And number two, also, again, because these loans tend to get repriced based upon how the interest rates move. So if we are able to bring the proportion of retail loans progressively up by 2 or 3 percentage points each year, I think this will have a salutary impact on margins as we go along. So that's number one. Within retail loans, the fastest growth has come from unsecured personal loans, which was a new business for us. So last year, the growth was about 100%. And now it has become a significant part of our business. So the book grew from about 10,000 crores to more than 20,000 crores. Now at 20,000 crores, it is about a fifth of what a home loan book is. But because of the margins there, it is almost contributing as much to, again, NII as the home loan book is. So as this grows, and I think we can grow this book to about maybe 4x of its current size before it reaches levels which are with comparable banks. I think that's a big tailwind which is there in terms of margins as we go along.
No, that's where I worry, because Reserve Bank apparently wrote a note to bankers and NBFC heads about unsecured loans and to asking you all to be careful. And everyone is in retail, and once the interest rate starts rising, do you think that your very good record in bad loans, gross 3.7 or whatever, will that be in danger?
So I think the Reserve Bank of India is right to sound a note of caution, but it also depends where are you in terms of your balance sheet. So there are banks which have got retail loans as 50-60% of the balance sheet. For us, it is about 23-24% of the balance sheet. On the other hand, it is corporate loans which are 43% of the balance sheet. You add international of 17%, it is 60%. So the risk that comes to the bank really is from a disproportionate exposure to corporate. And as we increase the share of retail, the fact is we are de-risking the balance sheet because of the granularity that is there in the portfolio.
Okay. All right. So in your case, it turns out to be an advantage. But time permitting, come back to it. But what about growth? Are you seeing signs of the capex cycle? You did 16% in the just ended year. What do you think could be the goal for when Mr. Chand takes over in FY24?
The fact is, you should always trim your sails depending on what is the direction of the wind. So there was a time over 2 years back when corporate growth was not there. So we grew corporate slowly, and that also meant that given the share of corporate, overall growth was also pretty much in line with the market. Last year there was an opportunity which was there because of the macroeconomic conditions. So our stance is that we will try to grow about 2% above whatever the market is, not having a fixed rate of growth, because there's no point pushing at a string, right?
But are you pushing at a string, or are you seeing enough hunger?
I think there is. So it is in what context? If you would take the context of the last year, I would believe there will be a moderation of the growth. If you were to take the context of the last 5 years, I think there's still room for an acceleration.
Okay, so 16 may be tough, but definitely at least 15, 14 would be possible, you think. Okay, the other point is credit cost. I mean, you have answered about asset quality, but this is an excellent credit cost, 0.4. Is that likely possible in FY24 as well?
So I think 2 parts to it. One is, to my mind,
or is there even space to go down?
Yeah, on a normalized basis, I would believe we should factor in about a 1% credit cost. That's what normal should be. Where we are today is because of a very positive improvement in the corporate credit cycle in particular, which continued even through the COVID period. I think it is likely to continue. This also gives us an opportunity. At some point in time in this cycle, the ECL norms will come up. To my mind, the fact where credit costs are gives us an opportunity to have overall costs, including ECL, within that 1% standardized figure, which means that the current trajectory that we see in terms of profitability, that should largely be unimpaired, even if ECL were to come in.
Okay, all right. Mr. Chadha referred to ECL, that is expected credit loss, which is a new rule that Reserve Bank is bringing in. You have to provide not just for loans already gone bad, but loans that may go bad, expected credit loss. We will have more questions for Mr. Chadha on that and on the digitalization experiment in BOB, which has succeeded so much. All that after the break.